What was First Republic Bank? First Republic Bank, a financial institution headquartered in San Francisco, had a specific focus on serving affluent clientele. In the year 2023, it faced closure and became part of JP Morgan Chase. The primary factor contributing to its downfall stemmed from a significant portion of its deposited funds exceeding the coverage limit set by the Federal Deposit Insurance Corp, FDIC. FDIC insurance safeguards deposits up to $250,000 per account holder, per type of account. Amounts exceeding this limit typically lack protection. By the end of December 2022, First Republic held deposits, of which 67.4% were uninsured, as per data analysis conducted by S&P Global Market Intelligence. The concern regarding uninsured funds intensified following the collapses of Silicon Valley Bank and Signature Bank, prompting a rush of withdrawals from First Republic. In the lead-up to its eventual closure, First Republic boasted $103.9 billion in deposits and $229.1 billion in assets. The majority of its assets were acquired by JP Morgan Chase, which subsequently rebranded 84 branches across 8 states, commencing operations on May 1, 2023. This ensured that First Republic's customers continued to receive seamless service, with their funds remaining secure. First Republic Bank's demise marked the third bank failure in 2023, alongside Silicon Valley Bank and Signature Bank, as per the Federal Reserve's list of failed banks. Collectively, these 3 banks held a staggering $548.5 billion in assets, surpassing the total assets of all failed banks during the 2008 financial crisis. Each client of First Republic had access to a dedicated First Republic Relationship Manager for personalized service. The bank's services centered around private banking, private wealth management, and private business banking. Private banking and private wealth management encompass services such as mortgage and personal lending, along with various types of accounts including checking, savings, and certificates of deposit, CDs. Private wealth management extended to investment management, financial planning, foreign exchange, trust administration, custody services, brokerage, and insurance. Private business banking offered tailored solutions to industries including venture capital, private equity funds, hedge funds, investment management firms, property management, real estate investors, private clubs, independent schools, medical practices, and wineries. History of First Republic Bank. First Republic Bank's inception dates back to 1985, when James H. Herbert Sakin founded it, primarily focusing on jumbo mortgages, CDs, and savings accounts. Initially, it operated in San Francisco, specializing in lending for luxury homes, second homes, condos, co-ops, and investment properties. In the late 1990s, First Republic expanded into a comprehensive bank, expanding its services and market presence on both the West Coast and East Coast. Over the ensuing decades, the bank's reputation grew due to its fewer customer accounts and personalized service, maintaining a steadfast commitment to high-net-worth clients. In 2007, First Republic merged with Merrill Lynch, which, in turn, was acquired by Bank of America in 2008. However, in 2010, Herbert secured private equity capital and regulatory approval to reacquire First Republic. Why did First Republic Bank fail? First Republic Bank's failure mirrored the struggles experienced by Silicon Valley Bank, SVB, and Signature Bank, including an excessive volume of uninsured deposits and liquidity challenges. Notably, First Republic catered to startups in Silicon Valley, with substantial balances far exceeding $250,000, contributing to its issues. This was exacerbated by the broader apprehension among investors regarding regional banks. Uninsured deposits. A significant proportion of uninsured deposits can trigger a bank run when investors become anxious. As of December 2022, First Republic had an affluent customer base with over 67% of its deposits uninsured. Lack of liquidity. First Republic primarily relied on net interest income from loans and investment securities. Many of its investments were in less liquid real estate loans and municipal securities, which did not yield competitive interest rates. Among mid-sized banks, First Republic had the highest ratio of loans and securities to uninsured deposits in December 2022. Credit ratings, downgrades. Repeated credit agency downgrades plagued First Republic due to concerns that capital infusions wouldn't resolve its liquidity, funding, and profitability issues. Mistrust in regional banks. Given the collapses of Silicon Valley Bank and Signature Bank earlier in the year, along with credit ratings downgrades, investors became increasingly wary of leaving uninsured deposits with a regional bank. First Republic sought aid from the Federal Home Loan Bank Board, FHLB, and Federal Reserve, and it received a $30 billion cash infusion from a consortium of 11 banks as deposits rapidly dwindled following the failures of Silicon Valley Bank and Signature Bank. Meanwhile, its stock price plummeted from $122.50 on March 1, 2023, to $3.51 on April 28, 2023. Timeline of the 2023 collapse. 2022, December 31st. First Republic met all capital ratio requirements to be well capitalized. However, the bank had already borrowed $14 billion from the Federal Home Loan Bank Board, FHLB. 2023, February 28th. First Republic's annual report outlined its challenges, including the fact that most of its loan portfolio was secured by real estate in California and the San Francisco Bay Area. The report highlighted a shift of deposits toward higher-yielding products and asset classes due to rising interest rates. March 6th, FRB's stock plummeted more than 75% within days and never recovered. March 10th, the FDIC closed Silicon Valley Bank, and First Republic began facing unprecedented deposit outflows. March 12th, the FDIC closed Signature Bank. March 15th, 19. Multiple credit rating agencies downgraded First Republic's credit rating, indicating a lack of confidence in the bank. March 16th. In an attempt to bolster liquidity, 11 banks contributed $30 billion in uninsured deposits. March 31st. First Republic Bank had borrowed $105.4 billion from Federal Reserve and Federal Home Loan Bank Board, FHLB funding. April 24th. As deposits dropped by nearly 41% from December 2022, First Republic announced plans to reduce its workforce by up to 25% and implemented other cost-cutting measures. April 28th. First Republic could not secure additional funding after borrowing $121.3 billion from the Federal Reserve and FHLB funds. Reports indicated that the FDIC intended to seek buyers for First Republic. May 1st, JP Morgan Chase acquired the majority of First Republic Bank's assets. Impact on depositors and investors. Following its acquisition by JP Morgan Chase, First Republic customers experienced uninterrupted service, and their funds were ultimately secure. The plan, as of May 5, 2023, involved transitioning First Republic's platforms and operations to JP Morgan Chase's technology over time. Certain existing First Republic branches were expected to be converted into JP Morgan Wealth Centers, and the bank's private wealth management platform was set to merge with JP Morgan Advisors. Who paid for the rescue of First Republic Bank? The rescue of First Republic Bank was funded jointly by the FDIC and JP Morgan Chase. JP Morgan Chase paid $10.6 billion to the FDIC for the acquisition of First Republic. The FDIC was slated to provide $50 billion in fixed-rate financing for balance sheet restructuring, along with some loss coverage for mortgages and commercial loans. The FDIC's share of the funding came from the Deposit Insurance Fund, DIF, which is sustained by quarterly fees paid by banks to assess their risk. The bottom line: First Republic Bank was one of several regional banks that encountered difficulties in early 2023, largely due to bank runs fueled by a significant volume of uninsured deposits and financial challenges influenced by prevailing interest rates. To safeguard your funds, it is advisable to maintain an amount below the minimum FDIC insurance limit of $250,000 in your bank account. If you require depositing more than this amount, consider opening another account at a different bank. For personalized advice on managing your finances, consult a financial advisor based on your individual circumstances.